Hi, everybody. Welcome back to another edition of VCTV. I'm your host, Kyle Ellicott. Before we get into today's event, introduce my co-host. Make sure you click subscribe, share, and give 2 big thumbs up to today's episode. Check out the archive on letoken.com to hear from today's speakers and all speakers of the VCTV family from around the world. Also, the comments box is open. We'd love to hear from you. So say hi, tell us where you are in the world, and we'll do our best to say hi back. And also, if you have any questions, throw them up. We'll do our best to ask them in real time. If not, we're all available online 24/7, 365. Big thank you to the Token team and to Maria for making today's episode possible as well. We're going to be talking about fundraising, but instead of earlier, we were talking about all of the opportunities in fundraising, including crowdfunding. Now we're going to talk about SPACs and the public markets in general and all the activity that's been happening in that area and what that means for you as entrepreneurs and as investors. With that, let's go ahead and introduce today's co-host. David, welcome up. First, welcome back. Pardon me. First up today, go.
How are you, Kyle? This is David Towell from ProChain Capital. I manage, amongst the other things that I do, I manage a crypto-focused hedge fund that invests across asset classes like tokens, equities, debt, early stage ventures through the hedge fund ProChain Capital. I've been involved in the investing universe. I guess that's relevant for this conversation for the last, 20 or so years. Prior to that, I traded distressed debt at Credit Suisse. And before that, I was a restructuring and bankruptcy attorney at some pretty prominent New York firms. Happy to be here. I've been watching the SPAC space for quite some time, actually. Before, I'd say the explosion, 2 close friends of mine who will remain unmentioned during this podcast, or I'm sorry, during this broadcast, started raising SPACs about 10 years ago and did so very successfully in the media and entertainment space. So I've had a fair amount of exposure to it over the years, and certainly, the legal structure and the financial structure of it is particularly, unique, and so is the current appeal to the market.
Wonderful. Thank you, David. Gary, welcome back. A little intro, a little background for everybody.
Yeah, it's great to be here, Kyle. My name's Gary Fowler. I'm a serial entrepreneur and investor. Done 17 companies. Was on the original management team of Click Software, which was sold to Salesforce for $1.35 billion 26 months ago now, so a little over 2 years. I am also the co-founder of Eva.ai, one of the top AI HR tech companies that I co-founded with Dr. David Yang, the founder of Abby. Today, I'm the CEO, president, and co-founder of GSD Get Shit Done Venture Studios, the premier AI and quantum venture studios. We search the world looking for incredible companies that want to go global using Silicon Valley support. Do a lot of work in Africa, a lot of work in Asia, Latin America, US, wherever those opportunities are, we're out there. We provide operational expertise to help companies grow, and of course, to move into the potential unicorn environment. Thanks, Kyle.
Thank you, Gary. Raghu.
Hey, thank you, Kyle and VCTV. I'm Raghu Rao, a serial entrepreneur, a strategic advisor, and angel investor from Princeton, New Jersey. I've been looking at SPACs more as a SPAC target recently for multiple firms, and I think this discussion would be something hopefully I can take some tips from. So,
absolutely. Thank you all. And David, speaking of that, Raghu, actually, David, I want to start with you today. Take us back in time and bring us to the present. How have SPACs changed from a fundraising opportunity in the public markets? When you started and others that started a decade ago to now, when they seem to be one of the hottest things in the craze of public markets. So if you can, walk us through that timeline of what has changed since about a decade ago.
So, first of all, a SPAC is a special purpose acquisition company. Doesn't tell a lot about, what it is, but essentially it's a pool of capital that is raised from the public. So essentially shares are issued And the purpose of those shares is simply to go ahead and provide capital to the head of that company, the board of that company, the leadership of that company, to go out and acquire usually a business. They may not acquire the entirety of the business. They may go ahead only and acquire a certain portion of the business. But nevertheless, it is a way to raise capital from the public in order to go ahead and deploy it. The interesting thing about it is, and Kyle, I hope all this background is good and important. I don't want to assume too much, potentially to put some members of the audience, out of the conversation early. So just want to lay a little bit of groundwork. So in any event, usually the SPAC is raised with some, well-known investors immediately. So whoever's raising the money knows a couple of folks that are going to go ahead and put in money into this SPAC to begin with, and then essentially go ahead and, for all intents and purposes, bet on the jockey. The leadership of the SPAC is then going to go out and find a target company. Usually there is some form of disclosure about either the industry or the geography or both, or the size of the company that the SPAC will go ahead and target. Doesn't mean that the SPAC is going to go ahead and announce a deal anytime, shortly after the raising of the SPAC. And sometimes, frankly, the SPAC is raised with a target already in mind. That happens as well. And so, to go back, apologies, this was something that was done either on two very far ends of the trustworthiness spectrum, Kyle. So on the one hand, you would think that someone that's had an incredible track record, right, someone that's so well regarded by the investing public, could easily raise a SPAC. They're going to go out and find an acquisition target, and they're telling investors, look, I've done really well over my career. I want to go out and find something. Frankly, I don't want to go ahead and identify that now. It may not be, that target may not be around, within a week. It may take some time, but go ahead, give me some money, and I'll go ahead and deploy it. The upshot from the investor point of view is that the stock is public, so therefore it's liquid. So if the investor doesn't like the investment once it's announced, or even after it starts to go ahead and coalesce, they go ahead and sell the stock. So it's not like someone's raising, money in a private equity structure where you can't go ahead and sell out or dump the position, so to say, right? It's a liquid public equity, and so therefore, it provides the liquidity to the investors. So it's a pretty good, structure for the right type of relationship. On the other end of the spectrum, someone that has absolutely no track record, and this is where the questions start to be, asked. Someone has no track record and is now going to go out there and raise a SPAC and going to go ahead and deploy it. Someone's going to ask, well, why would you ever give this person money, if they don't have any sort of, success at this? And that's sometimes when it becomes a little bit frightening and becomes a trend. Where we are right now is there are, interestingly, a lot of very kind of growth-oriented speculative companies that if they were to try to go public on their own merits at this point, it would be very difficult for them, because they would be pressed to go ahead and justify, A, when they might reach free cash flow positive, and B, go ahead and justify the valuation that they're looking for. So a SPAC is a way for one very big, very trusted investor to go ahead and say, okay, I'm going to take this very speculative enterprise public, and I'm going to do it through the operation of the SPAC. And that is what we're currently seeing. Because of a lot of very interesting growth situations that exist, mostly based in tech, some of it related to blockchain, other stuff not, there is a lot of SPAC activity. Now, let me just take it one step further and then I'll stop talking. I'm sorry for the long monologue, but we've gotten to the point now where not only folks with investing background have gotten into this game, but we now also have corporate titans, frankly, that don't manage money. They just manage businesses or companies, are raising SPACs. And then we also have celebrities that are raising SPACs as well, which, again, you could argue a celebrity is simply noted for what it is that they do, whether it be in sport or music or acting or something else. And them being able to identify a very profitable investment opportunity, may very well be totally disconnected from what it is that they're good at. So that's where we are right now. And so it's the confluence of a lot of speculative businesses that are out there, and because of technology, there are very, very high sights set for a lot of these businesses, and at the same time, it's caught on and it's been enabled by the fact that there is just so many people out there doing it, raising SPACs, and so you marry the two together, and we've got a frenzy going on.
Thank you, David. That actually provided a great foundation for today's discussion. Raghu, before I go to my question, I want to come to you. You wanted to learn a lot from today's panel. And first question, do you feel like you've learned something? If not, do you have a question for David to maybe clarify something further? I'm changing the format a little bit. I want to make sure you're learning today.
David, that was actually a very nice summary to start off with. My question has to do with a company that does not have like usually for listing an IPO, you need like a couple of year track record and things like that. But something seasonal, like right now, for instance, I'm looking in the COVID testing space, the diagnostics, which a year ago or a little over a year ago wasn't really something anybody would even have looked at, necessarily, but it's something that's needed to open up the economy. So things like that are very hot right now, a requirement for the next couple of years to go like, would they make good targets for a SPAC because they don't have a lot of track record, but they may have technology that's pretty proven.
Yeah. So, Kyle, may I answer?
Yeah, go for it.
Okay. So I guess the question, before I get directly to the question asked, the question generally opens up the topic of, this broadcast, which is, what do I think, or what does the panel think about, the proper targets for SPACs? So look, when you think about a SPAC, Raghu, I think it's important to think about, well, what are the options for a company, right? That's at that stage that you're talking about, right? Which is, it's a great idea. Maybe it's started to generate some revenue. So it's not just an idea at this point. There is proof of concept, but maybe it's in a crazy growth mode. And frankly, it just doesn't have any free cash flow. And it probably won't have free cash flow for some period of time, but there certainly are justifiable projections to go ahead and, see, a clear point where free cash flow will be achieved. So for purposes of the owners of that company, right, to raise capital, there are a few different ways, right? I mean, this could be a little bit of a corporate finance class, I guess, in some sense, which is they could go ahead and, raise capital through debt, which is usually going to be the cheapest cost of capital. They go ahead and sell equity, and they could sell equity in different ways. They can sell through the private markets. They could sell it through the public markets. So traditionally to a private equity firm or, some other private investor, or they can list their stock publicly through an IPO, or they can do this kind of, backwards type of listing. And Kyle, just to go back, to the first question that was asked, before there were SPACs, there were reverse listings, right? You'd have companies that are out there that don't really have a business, are still listed public companies, and they're a shell. And so if a business wants access to the public markets and they don't have to want to go through the whole process of an IPO listing and all the things that is required with that regulatorily and fee-wise, they could go ahead and essentially go public in a minute, through a reverse merger into a shell company that's already public, right? So that's it's SPAC by another name. And so those are the different forms. I would say that right now, when it comes to SPACs, in terms of what type of business is going to be most interesting for a SPAC, it's going to be something between, and I'll narrow it very quickly, but let's just start with these very broad parameters, somewhere between a very old line business. I don't think old line businesses are particularly good for SPACs unless they have an incredibly new take on the business. And I'll get to an example of that in a couple of minutes. And on the very other end of the spectrum is a very speculative business that has absolutely no revenue. It's just an idea, right? So I think it's stuff in the middle, i.e. it's, a big growth business, usually linked to, I would say technology, but, certainly, health is, I think, in particular ways, very much growth oriented. There is some revenue. The growth prospects are enormous. And, ideally, there is some clear path to free cash flow. To me, that's what, a SPAC, probably is most looking for. Now, mind you, Raghu, a lot of them are, again, like I said earlier, very much tied to a specific sector or to a specific geography and a specific size of company, right? So you don't want to go barking up the wrong tree. You want to go ahead and look at, the prospectuses that have been filed, by various SPACs and say, okay, this makes sense. I can fit into this SPAC's description as opposed to, something that's clearly outside the boundaries of some other SPAC. But that said, and we asked this question, interestingly, Kyle and I, we were on another broadcast last week. You got to think about, why is the SPAC the right answer, right? Again, at the end of the day, the SPAC is just an answer for capitalization, and exposure or liquidity of the equity in the business. And the question is why are you going this route? Is it cheaper? Is it faster? Is it better in some other way? Why are all the other alternatives not right for the business? And if all the other alternatives are not right for the business, you should be asking, well, if no other alternatives are right for the business, is it possible that a SPAC is right for the business? I'd say 9 out of 10 times you're going to find that there's probably, certainly an alternative, and B, maybe an even better alternative, to the SPAC capitalization.
Thank you, David. I think that is interesting. I just wanted to extend that a little bit. You specifically mentioned reverse merger versus SPAC, right? To kind of maybe dig down a little bit further there. The amount of the corpus, the trust fund that is available already in the SPAC, it only is a portion, right? They still do pipes, when you based on the size of the acquisition or whatever. Is the fact that there is already a corpus and to some extent a good team differentiate that from traditional reverse listings?
It doesn't distinguish it from traditional. It distinguishes it maybe from the bad ones. So look, if you've got the right trappings, the world should be your oyster, right? If you've got a great business, if you've got great growth prospects, then you should be able to go ahead and, figure out the best path for you. You probably have all options open to you. So, there's nothing that compensates for great fundamentals. And maybe this goes to a broader question that hopefully, Kyle will discuss, which is the success of SPACs, right? Is it a flash in the pan? What percentage are not going to make it? What industries is it good for? Which ones, are going to be around a couple of years from now? And I think when it comes to answering all those questions, the short answer is obviously the best businesses are the ones that are going to best be equipped to survive and thrive, as opposed to, the weak ones. They're going to get pummeled no matter which way they go, whether it's be SPAC or otherwise.
So with that being said, thank you, David and Raghu. Gary, I want to start with you on this one. Give David a break for a minute. What industries are interesting for SPACs as we're starting to see things take shape here in 2021? What interesting industries are you seeing in the public news and markets in general that could be interesting for that?
Well, remember, I'm a country boy from Pennsylvania, so let's keep it Keep it simple. So what's hot right now? We got a lot of data around us that we need to deal with. We need to have companies out there, whether they're enterprise software companies or cybersecurity companies, that are able to address those kind of data issues, the issues of infobesity. So, from my perspective, companies that are very interesting are companies around artificial intelligence, enterprise software, quantum computing, things that are going to really make a dent in the universe. And David said something real that's really apropos. And this is again, this is like, let's keep it simple. You get a tried management team that's done it before. It's like winning the Formula One with a Ferrari. If you've won it one time and you've been around the track and you understand what elements of a team are important, building the right kind of teams from both the get stuff done perspective and also a management perspective is critically important. So those kind of fundamentals, and then having the right kind of connections to go out and find that company. So there's a lot of competition with SPACs, but having the right kind of team of management and also advisors can really help you identify what kind of companies it could be really interesting to bring into the fold. Net is the key. Is this is about creating a business, and having gone down through an IPO myself, it takes a long time to do it from my perspective, and it's arduous. The SPAC lets us do it a lot faster and at the same time reap a lot of the benefits. But when it's all said and done, it's about results. What have you produced? What is it worth? And is that company really the right company to be able to have incredible growth and value for shareholders?
Thank you, Gary. Raghu, similar question.
Yes, I think one of my questions is that because of the way the SPAC model operates, in which you have a specific timeline to find the target and demerge, do the SPACs end up giving a higher price than a traditional IPO, if assuming the company is great anyway? So is that maybe David or Gary or Kyle may shine some light on this?
I'll give it a shot. Yeah, I'll give it a shot. So, how far can the market overshoot on value? I don't know what the data says, and it's a very interesting question from a numbers perspective, and I don't even know if you could crunch the data because you're trying to ask the question, well, what if? And I don't know if we'll ever know that alternative reality. But from a rational point of view, anybody can, overreact or underreact. That's why, frankly, I mean, to go back to last week and Coinbase and, just full on public transparent price discovery, I think that's best. When you do a traditional IPO, you're relying on your roadshow and your bankers and your order book to tell you what the right price is. And we've seen, great calls. We've seen, way over and way under valuations in history. And then the same thing. I mean, SPAC, you're talking about, essentially a couple of human beings, if not only one, that's going to go ahead and decide on the value of the transaction. The market will immediately react, after the transaction goes through and the acquisition happens. But in terms of deciding, what the right price is, it's going to be up to the SPAC, the investor, to go ahead and figure out the price. And so there may not be very good price discovery, in connection with that. So I'm sorry to not give a great answer when it comes to that. I think I guess the right way to say it, though, in order to leave an answer, in my view, is more data is better, more voices is better, more opinions is better in terms of reaching accuracy. And that accuracy is accuracy as of today. It says nothing about, what the value is, 2 years from now. But that's the way I think of things. I like things to for them to be, kind of much more market-based, democratic, as opposed to an off-market, kind of one bullet type of, shot. And frankly, more than anything, that's what a SPAC is. And by the way, we haven't spoken yet about the dynamics of the SPAC in terms of the investors or the initial investors in the SPAC and what's their kind of motivation for being invested in the SPAC. Can they get all sorts of sweeteners? The SEC is now looking into that. And what's the accounting treatment relating to all that stuff? So, to me, again, I think SPACs have had a great run, not because they're deserving of it, but because it just happened. That was the market. That's what happened. Do I think it's going to come to a screeching halt? I don't think so, unless there's a spectacular blow up or a huge legal regulatory problem that happens, which I don't see either one happening. And I think it'll be around for a while, but I do think, we might have seen, at least for this stage, its best days. I don't think, going out with a brand new SPAC right now, unless you've got something, very particular about, your SPAC track record, it's going to be so easy to raise the money right now.
Thank you, David. Raghu, does that answer your question?
Yes, thank you, David. Yes.
Kyle, can I say a couple of other things just in contrast to Gary? So I totally agree for Gary to be focused on the sectors that he's focused on. That's where he has, his expertise. Those sectors are not my expertise. To me, one of the most interesting sectors is consumer products when it comes to SPACs. And that can be anywhere from, taking a spaceship to the moon or baseball cards. And I'd like to focus on those two examples in particular. Happy to talk about, some other consumer-based SPAC businesses. But with respect to going to the moon, Virgin Galactic, in SPAC form, to me is silly. I think it's a company that should remain private for a considerable period of time, at least until there's some, real activity going on with respect to the business, in terms of substantial, revenue activity. I think it's real speculative. And to have two big investors in the name who essentially are, day one forces behind the business selling out of stock, I think is very bad form for the SPAC. I don't know if the SPAC is going to, I think that the SPAC is going to suffer as an investment vehicle, if founders are selling out of the company stock, whether those, sales are motivated, even by extraneous things having nothing to do with the company itself. I just don't think it's in good form. And I think the business is not at a stage where it should be a public company. When it comes to other consumer-based businesses, I'd like to use Topps as an example, and we haven't seen it, start trading yet. But Topps baseball cards is supposed to be the target of a SPAC that was raised by a distressed investment manager by the name of Jason Mudrick, managing a hedge fund called Mudrick Capital. And he actually did very well inside of his hedge fund, buying at a very discounted price Enjoy, which is a e-cigarette company that he bought in distress. And it was at a time when, e-cigarettes were under a fair amount of regulatory and legal pressure. And that business had, done poorly for other reasons beyond the legal and regulatory part of it. And he was able to buy it at such a discounted price and to understand that there is fundamental value to the business. Forget about, selling bubblegum flavored e-cigs to 13-year-olds, but there is in fact, a basis for the business in terms of, I'd say a place in the market for, a mature, let's say, smoker that's using it either, for pleasure or to wean him or herself off of cigarettes. I think that's what Mudrick is doing with this acquisition in Topps. It's just outside of his hedge fund. He did it as a SPAC. The first thing is Topps is a baseball card company. You could look at what they've done We can argue about, value of cards or the physical form. We'll pause there for a second regarding the digital form or the NFTs. But he's buying the company at a very low valuation. The second thing is he's got an incredible, leadership team in terms of the chairman of the company is going to be an ex-CEO of Disney. You're talking about real leadership, real visionary. And then lastly, the reformulation of the business, is around digitization of the novelty of sports memorabilia. And I think that there's real merit to that. Obviously, also, there's a confection side of the company with respect to a bunch of candy brands that the company owns that does really well. So there is, a full kind of floor of the business that has nothing to do with sports memorabilia. So to me, that's a really good SPAC in terms of it's a turnaround play being bought at a pretty low valuation price with pretty top talent with very good track record. There will certainly be naysayers, and the business plan is not foolproof. But to me, that is a good paradigm, let's say, for a SPAC acquisition.
Thank you very much. Raghu, any last questions? If not, I want to come to closing thoughts, but I want to make sure you get your questions because you wanted to learn a lot today. So did you learn a lot?
Yeah, I'm good. I'm good.
All right, good. I don't want to forget about Gary either, but you said you wanted to learn something, so I hope you learned something. I hope the audience did as well. I did as well. So this was great. Gary, let's start with you. Closing thoughts. Where can everyone find you online to continue the conversation?
Yeah, so from my perspective, SPACs, as I said, I'm particularly interested in AI, cybersecurity, enterprise software. So that's what we know, and that's of interest. I think that there's, with the world being in a state of infobesity, it's a great time to be able to look at companies that really focus on those areas. So I'm excited about it, excited about the times. You can reach me, Gary Fowl, on LinkedIn or Twitter. Love to hear from you. I'm the CEO, president, co-founder of GSD. We help companies go global. Let me know. Thanks.
Thank you very much, Gary. Raghu.
Yeah, I think I definitely learned a lot, and there's a lot of thing to be said in terms of history, right? Right now we're just kind of having this 105 billion or whatever ready to be deployed, and we'll see about a year later how some of these, maybe 2 years later, really how some of these work out. But definitely, it's given us, I think, a lot of companies an avenue to exit to the public market, which may not have been ready before. So I think that's a good thing. And as I think Gary mentioned, we have to tread cautiously, but it is definitely an opportunity that's out there. So look forward to participating on both sides, potentially investing in a SPAC as well as looking for a SPAC exit for some of my companies. And you can reach me at Raghu S. Rao on LinkedIn. So look forward to more discussion.
Thank you. David, close us out. Quick closing thoughts. Where can everyone find you?
Yeah, sure, Kyle. Thank you very much for the panel, by the way. Gary, Raghu, it was always a pleasure to talk. I can be found on, go with Twitter, ProChain Capital, and then you can reach me by email at david@prochaincap.com. I think my parting shot will be to start to watch out how hard potentially the pendulum swings the other way on this. At some point, once a few of these SPACs start to really fail, how much shorting of these SPACs will there be in the marketplace? It could be a violent, episode the same way the SPAC raising happened. And so it may fall out of favor, as hard, maybe harder than it gained prominence. So, just beware.
Wonderful. David, Gary, Raghu, thank you very much as co-hosts today for sharing your thoughts and insights around SPACs and fundraising in the public markets. David, thank you so much for providing us such a great foundation and educating the three of us more as well with the audience again on today's topic. To our audience, thank you so much for tuning in. Thank you for all the great comments, the hellos. Hello to everyone as well. And make sure you click subscribe, share, like the episode, check out the archive on latoken.com to hear from today's speakers and all speakers of the VCTV family. Make sure to reach out to everybody online to connect and to continue the conversation. Add context where you heard them, where you met them, and what you would like to continue the conversation about. Big thank you to the Token team and to Maria for making today's episode possible. I'm your host, Kyle Ellicott. You can find me along with my co-host today online 24/7, 365 at Kyle Ellicott. With that, we'll see you back here tomorrow with more VCTV. Take care, everybody.
Bye-bye.
Bye.